March 21, 2026. This is the 22nd day of the Strait of Hormuz blockade. Thousands of commercial vessels remain stationary, caught in a physical, logistical paralysis across one of the world's most critical energy arteries. This line chart shows the immediate translation of that bottleneck into a price shock. Brent crude volatility sent prices peaking near $120 a barrel as the market reacted to the sudden supply constraint. Prices settled at $107.87 by Friday's close. This retracement follows unconfirmed diplomatic reports that Japanese vessels may be granted safe transit, triggering a tactical relief rally across energy desks. This energy cycle is now colliding with the rigid monetary frameworks of Western central banks, who are maintaining high interest rates to combat persistent inflation. The result is a stagflationary pincer. Stagflation describes an economic environment where stagnant growth and high unemployment occur simultaneously with rising prices. Here, manufacturers face surging input costs while dealing with restrictive borrowing rates. This physical maritime bottleneck has transitioned into a structural financial crisis. Current valuation models are struggling to account for the instability in baseline energy costs. The March 20th trading session revealed a central paradox. While major equity indices staged intraday recoveries, institutional panic metrics remained at extreme highs. The global VIX is a real-time market index representing the market's expectation for volatility over the next 30 days. It is currently spiking to 27.29, which indicates that institutional portfolio hedging is at its most expensive level in years. This fear gauge is mirrored in emerging markets. The India VIX surged 18.4% to hit 21.05, signaling a sharp rise in expected volatility for the domestic tape. Central banks are maintaining a higher-for-longer stance on interest rates. This rhetoric forces institutional players into expensive defensive positions to protect against weekend escalations. To navigate this environment, we must deconstruct the March 20th tape to identify exactly where capital is liquidating and where it is seeking cover. In a stagflationary environment with high volatility, headline index levels can be misleading. Survival depends on tracking the actual movement of liquidity. The U.S. macro environment is entering a pre-logistical crisis where domestic manufacturing is hit by supply costs before production even begins. Raw material data confirms this pressure. Sulfur and copper costs have spiked 25%. Analysts are watching a critical psychological floor at 6,550. Historically a base for buyers during industrial stress. A breach here triggers systematic liquidation from algorithmic funds, reacting to industrial data by selling toward the 6,400 level. In Europe, the energy crisis is more severe and structural, placing intense pressure on the continent's industrial core. The European Central Bank has maintained a hawkish stance, leaving the deposit rate at 2.00. As long as the Hormuz deadlock continues, the automotive and chemical sectors in the West face a significant derating in their fundamental valuations. The energy shock is hitting net oil importers the hardest. In Japan, the economy is being squeezed as the US dollar moves toward 160 yen. This chart tracks a geopolitical hedge rotation. Capital exits the Eurozone and Japan, flowing into Middle Eastern markets, building massive fiscal surpluses. Technical data for the Abu Dhabi Securities Exchange forms a bullish pennant consolidation pattern, facing current resistance at 9,800. A broader collapse in Asian markets is currently being mitigated by the China pivot. Chinese industrial production data recently showed a 6.1% increase. This unexpected surge in activity has provided a tactical floor for regional manufacturing sentiment. Simultaneously, institutional players are moving into the US dollar index, currently at 100.18, and Bitcoin at $70,394, using them as safe haven assets. The combination of Arab energy windfalls and Chinese industrial output is creating isolated buffers against the wider global market decline. The Indian Nifty 50 index provides a clear view of the struggle between international capital and domestic absorption. On the surface, the market looks resilient as the Nifty 50 rebounded on Friday to reclaim the 23,200 level. Below the surface, foreign institutional investors are exiting, selling 5,518 crores in a single session. However, this selling was entirely absorbed by domestic institutional investors, who deployed 5,706 crores to hold the market floor via retail inflows. In the derivatives market, FIIs are using delta-neutral strategies. A delta-neutral position is designed to have no directional bias, protecting the investor from sharp moves up or down while volatility remains high. They also hold a negative 823 crore position in index futures. This acts as a direct hedge against the risk of the market opening lower after the weekend. The current market floor is sustained by this domestic buying, which is working to offset the persistent exit of foreign capital. Managing a portfolio becomes difficult when the local currency is depreciating. The Indian rupee recently hit a record low of 93.71 against the US dollar. Foreign sellers focus on high beta financials. A high beta stock is more volatile than the broader market. This is evident in HDFC Bank, which dropped 2.15% and pressured the wider index. To counter this, domestic capital is rotating into export-heavy IT firms like Tech Mahindra and Infosys. These companies earn revenue in dollars, providing a natural hedge against a falling rupee. There is also a move into ferrous metals, including JSW Steel and Tata Steel. This rotation is an attempt to get ahead of supply chain gaps created by the blockade in the Gulf. In this environment, investors are moving away from broad market tracking and towards specific currency and supply chain buffers. Geopolitical developments remain a wildcard. The U.S. is considering a $200 billion funding request for Gulf munitions, creating further regional military uncertainty. The relief rally seen on Friday masks a liquidity imbalance where strong domestic buying is the primary buffer against a persistent foreign exit. The Nifty put-call ratio, a metric used to gauge market sentiment by comparing the volume of bearish put options to bullish call options, sits at 0.84. This indicates a bearish bias, with a heavy cluster of bets placed at the 23,000 level. For the Monday, March 23rd session, the 23,100 level is the critical support zone to watch. If the Nifty fails to hold 23,100, it could trigger an algorithmic slide toward the 22,700 floor as funds deleverage their positions. The Hormuz war premium currently dictates the global pricing matrix. Investors should prioritize geopolitical hedges and track the balance of institutional flows as the blockade continues.